Evening and welcome to Traders Group. Let's get started by, as per normal procedure, having a look at the S&P 500 and coming through the different sectors of the market, looking at the market from the perspective of of traders and also of investors, and understanding where you should be at this present time. First of all, this is for, I suppose, investors. I just want to once again just do a very broad brush picture just to get started by putting up a monthly chart. And I believe I've done this many times before, but it's good to just continue to reinforce just an aspect or a technical aspect of this market. And the reason for doing that is that I suppose a weekly chart would have been good enough, is that we are faced every week with quite negative news on the TV. And I just want you to, as you all are, be immune to that negative flow of information, because there's only one thing that matters in financial markets, and that is the technical trend. And the technical trend of the S&P 500 is up. The reason I'm bringing this up continuously, because the flow of negative information, mainly coming out of the activities of the White House in the United States, it's a real stream of negativity, which had someone last week wanting to close their portfolio, and I beg them not to, because it doesn't make sense. There is zero technical evidence that the market is doing anything than grinding its way to the upside. In fact, putting any activity from the US government to one side, especially the president, it's actually quite irrelevant. The market seems to ignore pronouncements out of the White House. It's just factoring in what is real. The real reality of it is the United States is currently in a strong period of growth. And I think I mentioned last week, counterintuitively, the actions of the Trump administration appear to be benefiting the US markets. Hence, to have any thought of exiting your portfolio while the market is in a upswing doesn't make sense. It is a slow grinding bull market. And I believe last week or 2 weeks ago, we were talking about the low of this market coming in and being most suitable for short-term traders, whether they be call option traders in specific assets, and or in my case, I supervise a group of diagonal spread traders, which have done extremely well in this latest move to the upside, or whether you're an investor. Now is the time just to sit back and manage your portfolio, slightly adjusting that portfolio as the market starts to move. This has been a grinding low momentum move since the February low. That could actually start to accelerate in the not too distant future as this market breaks into a new high. Not being positioned in this market since April would be, looking in hindsight, would have been a mistake. And I'm talking full commitment to both the Australian and the US markets. And that, for most, has been a difficult thing. And the reason being, I've just mentioned it, all you hear on TV is negativity. It has got nothing to do with what's happening in global financial markets. Hence, looking at the current market and in very short time frames now, I make the observation that last week I told you that the market is doing regular 12 to 13 days in these moves to the upside. And I will point out that if we, depending on which low we take, the market is 13 days up from its low. Maybe we could count 14 if we took the previous bar. Is that a guarantee that the market stops there? No, it doesn't. And my view is that it probably potentially may continue to the upside, but it is very predisposed at this point to a counter trend. And why is that important? Well, two reasons. If you're a trader, if you are taking new positions at this point, they are high risk positions. Why? Because you're buying into a extension in the market. That extension may fail in the not too distant future, or it may go to the next Fibonacci. The question is, which Fibonacci am I talking about? There are three ranges marked up on screen. The previous range was kind of small. I can mark it up on screen, take it from the low, and I make note it hit the 100% Fibonacci ratio in the last 2 sessions, I'll mark that particular line up, and I'm also going to mark up the next Fibonacci level, and then I'm going to delete it. Because to be honest, I don't know which Fibonacci it's going to work on. I could use the previous the previous range, work that Fibonacci up from the low, and it gives me a different level. So when I look at this, I still see strength within volume, and I'm talking short-term strength. So there's every possibility that this market may continue on up. Interestingly, if that does continue on up, that is it's breaking that pattern of the 12 to 13 days to the upside on these extensions. That does not take away from the fact that from now on in, it's high risk trading. If you are trading to the upside, most of this trend or most of this rally or most of this leg up has already occurred in the past 2 weeks. Therefore, there's not a lot of upside from my point of view in this market. Hence, I'm just giving you a word of caution. If you're trading SPY diagonals, now's not the time to load up on positions. Now's the time to be cautious and position size accordingly. So, in summary, where's this market going? It's going to the upside, and until proven otherwise, that proven otherwise would be a dramatic decline in volume, which I can't see. In fact, from last week, this is big picture volume, I see a dramatic increase in the level of institutional volume behavior supporting this market to the upside. Putting aside potential counter trends, that comment is true, whether I'm looking at just overall volume or whether I'm looking at specific volume of advancing and declining stocks. When I look at the advancing and declining stocks numbers, I'll go back 4 weeks. 4 weeks ago, there was 203 advancing, 273 declining. Jump forward 4 weeks, there is 298 advancing and 186 declining. What's significant about that? That number, that advancing number, is the second highest number I've seen in maybe a year. The highest number that I've seen this year was at the high in January, where the number was 305 advancing stocks for the S&P 500. Significantly, it's not the number, it's the volume of the number. And here's what's very significant. The volume of advancing stocks versus the volume of declining stocks is 40% greater. I have not seen that disparity. That's huge. So the volume, the numbers, nearly higher than I've seen it in 6 months, and the volume is 40% higher. What does that tell you? This market is getting stronger, and it's not weak. It's not a weak market. It's actually a very strong market. And the internal numbers of advancing and declining tell me that is a true statement. In terms of new highs and new lows, it's not as amazing as advancing and declining. But 4 weeks ago, in terms of new highs, new lows, there were 17 new highs, 8 new lows. Jump forward 4 weeks, there's 23 new highs and 1 new low. So that is interesting. There's nothing weak about what we're seeing in front of us. When I come across to the VIX, I'm looking for weakness in the markets would be a rising VIX contract. I see nothing of the sort. All as I see is a continually declining VIX contracts, which means no one's hedging, there's no fear within this market, and it continues week by week to go down a significant trend line. I could draw that trend line back in to make it a bit smoother. So there's nothing indicating any fear within global financial markets at the moment. Let's jump across to IWM, the mid-cap shares in the United States. There is something interesting in here, which will come true if the market goes up this evening. And that is, this market has produced a shallow pullback, which is kind of interesting because if it does go up to the next Fibonacci, it's a very shallow pullback on that leg up to its 100% extension. So if it doesn't do that, it's actually a sign of weakness. So it looks like this leg up is not complete at this point in time, both for the IWM and the S&P 500. If I am wrong you'll see a market top out probably starting this evening. But as I stand here today, both from price and volume, it still indicates the market is moving to the upside. Even though if I jump across, if I want to add some doubt into my own head, I look at the S&P 500 futures, they're down slightly. Moving along to the other global indices, which I believe are important to keep an eye on. The most important is the DAX and the Shanghai Composite, and then we come to Australia. In terms of the DAX index, looking at the pure DAX chart, it has done a perfect accumulation phase and a pullback back to 0.618. Since that pullback back to 0.618, it's done a series of higher highs and higher lows with a flattening to rising 20-period moving average. This is, if I changed it to a weekly chart, a perfect W pattern with a deepish pullback, but it is absolutely normal. I can jump across to EWG, which is contorted due to the fact of currency movements within global financial markets. And I would suggest that this had a huge fall. And you know from past work that when markets have a huge fall, they end up being inverted head and shoulders. Is it an inverted head and shoulders pattern? Well, of course it's not, but it has had a large plunge. But in the very near future, that's exactly what I would suggest it probably will end up being after a huge fall. We often have a very large rally, and it looks like that's exactly what has started already in the last 2 weeks. So if this market moves up, has some sort of right shoulder, we've got ourselves a beautiful inverted head and shoulders supporting EWG for Germany. Let's come across to FXI. Again, FXI, I believe the chart's quite strange due to currency effects, and it has been extremely weak. That said, we've got this period of bouncing a bottom where it's touched it 3 to 4 times. That's kind of like a base building. The only thing that supports a base on the FXI chart would be volume, and positive institutional volume has just popped its head up for the first time in 1, 2, 3, 4, 5. I keep 5 weeks of volume on handwritten volume on my pad in front of me. So this is the first time I'm seeing green numbers on my screen with the market bouncing along. That said, that is also a true statement for Germany. So it's not just that we're seeing potential pattern evolution, we're seeing institutional positive buying volume kick into the market and support the contention that we have potential lows starting to evolve. Coming across to the Shanghai Composite chart, I'm just going to leave the patterns on that we've had. This is also a really large fall within Shanghai Composite. Is it going to turn out to be a inverted head and shoulders bottom forming a base? I don't know yet. It's a little bit early to call, but it looks like that has the potential to evolve in that way. And if it does, it'll have a large rally. It's too hard at the moment. The moving average is still pointing down. It looks like it's going to retest. I won't go any further on that. Interestingly, the Shanghai Composite or Chinese markets are highly correlated, as we know, with the commodities markets. Hence, the commodities markets, especially metals and mining, have been quite weak, but not plummeting, but quite weak in the last few months. But specifically, there is one commodity, one particular metals and mining that's very highly correlated with, and it's it's copper. So I'm just going to pull up the copper futures chart. I'm not going to agonize over this. The reason I'm bringing it up, it's had this massive collapse. And if we're talking about a base within within China, there could be a base coming up within the copper chart. I'm sure there's an exchange traded fund in which you could trade copper, and maybe I'll go and I've got a bit of spare cash at the moment, maybe I'll go and buy some if I see this market forming a base. I didn't do any volume work on HG. Just let me write a note. HG is the code. Just give me one moment. I've got to write myself a note, so I should have done that. HG and volume. Okay, so my point is, if you look at the top where I just drew the arrow, the very top of this market represents the 7th of the 6th, 2018. Let me come across to the Shanghai Composite. Open up the chart. The top of the beginning of the last fall was the 7th of the 6th, 2018. So Is there a high correlation with the Chinese market and copper? It's a well-known fact. Yes, there is. And if we're talking about a base in copper, if we're talking about a base in the Shanghai Composite, if you want to trade where there could be a huge reversal to the upside, maybe copper. It hasn't happened. I'm not calling it. I'm just saying that there is an opportunity there. Maybe I'll watch it in the next few weeks, and maybe I'll jump on board if I see something exciting. So there's lots of good things to look at, including XME. Let's just connect the Chinese market to metals and mining, because the Chinese market is highly correlated to that specific area of our markets, and we're highly dependent on them for our wealth in terms of the mining that the resources they buy. In terms of XMM has been in a triangle. It's bouncing sideways. It hasn't broken to the upside yet, but it also hasn't broken significantly out of this, what appears to be a reasonably symmetrical triangle. If I look at the volume picture of XME for the first time in 5 weeks, it is showing positive volume. So that's something which is new. So if you were to tell me which way is this probably going to break out, down or up, I have to, on the basis of volume, say probably it'll break to the upside. Not only do I look at XMM, I look at XME, which is the US exchange traded fund relating to metals and mining, as it pops up on your screen. And what you'll note before I came in, it was a bit concerning because this market had broken down through its trend line, and also on a sector rotation chart, had rotated into the weakening quadrant as of this week, but it's put a base. It looks like it's building a base. And that base is supported by volume that is buying institutional volume. It only just kicked in this week. So that base is supported by positive buying behavior, which means the probability of this being a W pattern is probably high. And in the next few weeks, I drew what I think may happen. It may evolve into a W pattern. It may break trend. If all that occurs, fantastic. That is another supporting feature of the Chinese market. So you've got all these interrelationships between, some metals and mining contracts, metals and mining in general, and the Chinese market, all looking good. All the negativity thrown at the Chinese by the Trump administration are now known. That's why the market fell. It factors in, I don't think it's even actually been activated, but it factors in the theoretical negative consequences of tariffs between the two countries. That's already a known factor. The market's already fallen. It doesn't fall on no future negatives. There are no future negatives. So that's a point where markets often put in a base. Think about the Royal Commission into Finance in Australia. We were talking about this only 3 weeks ago. The focus had shifted off the major banks and onto the peripheral nasties in the financial banking industry within Australia. All the negative news, what appeared to be all the big negative news, had already been presented to the Royal Commission, and just shortly thereafter, what happened in Australia? The finance bottomed out and has formed a significant basing patterns. We'll address that in a moment. So everything's looking really quite good. And if you're looking for negative elements, technical elements that could make the indices fall over, I can't find any. Let's come across to the Australian market. I'll very quickly put up EWA, but again, it looks like a real mess at the moment because of the currency movements. That said, if I look at the volume behavior of EWA, it is actually it's gone negative again. It was super positive last week. I'll have to keep my eye on that. It is a little bit negative, but that's EWA. It's not XJO. I haven't got volume information for XJO. Coming across to XJO, what do we see? Well, we see a market for the last 3 weeks that has backed off, and we have a Fibonacci ratio based on the range from the April low to the May high, which projects the 100 Fibonacci ratio at 63.87. What's the chances of it getting to 63.87? I reckon pretty high. Check out the moving average. Is the moving average pointing up or down? The moving average is pointing up, and it looks like we're about to break trend to the upside. I thought it was going to do it today. Let me come down to a 60-minute chart. Often that provides us with a little bit more detail into exactly what's happening. And Alan just put up a information which I'll draw on the screen in a moment. Alan, that's Alan H. That's New Zealand Alan, not East Coast Australia Alan. Okay, so let's just. So I just like to blow things up, and I like to say, okay, trying to find patterns within in the market. Okay, so there is no W pattern. There's nothing there at the moment, but you can see what could be potentially happening if the market in the United States did continue on the upside. If this did break its swing high on a 60-minute chart, it's a sign that yes, this is probably going to break trend and go for the next Fibonacci. It has not occurred yet, and because it has not occurred yet, from W patterns, if it failed at this point and broke the swing low, the reverse is true. So if you were index trading the local market, I would be working off a 60-minute chart and wait for confirmation this is a base, because the reverse can be true and sometimes is. So have the patience if you're index trading. Coming back to the daily chart, just drawing up on screen what Alan just pointed out. I'm just going to blow it up a bit. And I need to clean up my screen because I've got now too much information on my screen. Look at all those blue lines. And Alan just pointed out that he sees what would be described as a rising flag. Or, we could almost argue it's a symmetrical flag. Or actually a symmetrical triangle. I think a symmetrical flag has to have a tail on it, which it hasn't got, but it's not that relevant. It is looking as if it's going to break to the outside. It is not confirmed just yet, but tomorrow, if it does do that, you'll see, I believe, a very quick move to 63.87, which won't take long. Our market, just sticking with the Australian market, is extremely strong. I keep on saying this week in, week out. Just in case you're in any doubt, go and examine your individual sector charts and ask yourself the question, on an individual sector chart basis, is the market looking weak or strong? We've talked about metals and mining, and we can zero in on some of the stronger sectors of the Australian market. Things like healthcare. Healthcare is absolutely fantastic, and it looks like it's getting prepared to go for another move to the upside. I won't do every single one, but information technology looks fantastic. Looks like it's getting ready for its next break. Consumer discretionary, another really strong sector within the Australian market, looks like it's making its next break to the upside. Consumer staples looking fantastic. I did skip energies because I cannot get excited about energies. I don't know why, but they have lost a lot of momentum, and I believe I still have not invested in energies, and I just don't think I will be. Every time I go to press the button, I back away. I don't care because you don't have to be invested in every area of the market. Once again, though, my message for the Australian market, and this is talking from a sector grouping position, there is only one sector, one, and that's telecoms. It's a pig. Here it is. And it's a very thinly traded area of the markets with a very small grouping of stocks. It has been a dog, continues to be a dog, and it's not worth even going near. All other sectors are fantastic. And especially in the last few weeks, we started to draw in these crazy looking inverted head and shoulders patterns on the finance market. So this is XXJ, which is finance minus REITs within the Australian market. And you can see what I can see. It is a inverted head and shoulders pattern. I've got way too much information on the screen. Just let me get rid of it, some of it. But it is a inverted head and shoulders pattern that's in the process of breaking trend and also looks like breaking its neckline. You can't get any stronger signal, technically speaking, than what's on screen. Okay, I'm just going to draw a very crude trend line. Okay, so it's doing everything it needs to do to break trend to the upside. and looking good. If it's doing it, so's some of the biggest shares within the Australian market. I told you 2 or 3 weeks ago, I jumped back into, as this pattern was forming, CBA and WBC. CBA has since just confirming what I believe to be true, and that is a continuing base which is putting in what was its right shoulder. It should be almost complete. If you look at the very crude left shoulder, it took a month, and that's exactly what's happening to this side of the pattern, and that's all very normal. It broke trend 4 weeks ago. It's putting in the right shoulder, and then such a broad-based pattern should resolve in a large extension to the upside. The wider the pattern, stronger the extension. That's how normally it works from what I've observed. Let's see how it unfolds. WBC was not as pretty, but still not unhappy. It's not even, I'm not going to try and draw a pattern on that. It's all too hard. Looking good. It's going up. That's all I care about. The other banks, the regional banks like Bendigo Bank, Bank of Queensland, they're all looking okay. So finance as a industry of, banks as an industry of finance, is it looking good? It's looking fantastic. It's supporting the Australian market, metals and mining, supporting the Australian market. Then come in all the other sectors of the Australian market. Why should you be fully invested? Because we're in a strong bull market, and if you're not, you're missing out. Okay, so just let's jump across just to complete that picture, just moving across to a GIGS level 1 Australian chart, and I just want to make a few comments on this. Clearly, XHJ on the right-hand side of the screen is the strongest sector. Energies has lost a lot of momentum, and I'm not very enthusiastic about it, but every other element on this chart is fantastic. XMM we've talked about. I obviously can see that this has lost momentum, but it is a weekly chart. What I would forecast within the metals and mining on this chart, it will do a strong right rotation, which is a signal of strength. Now this hasn't even happened. I'm just forecasting it from experience. When I look at all other elements of this particular chart, it is looking great, except, what did we say? Telecoms. I have made this point many times in the past few weeks. When we compare and contrast the rotation chart between the United States and Australia, is a completely different story. The US market has many lagging elements, and some of those lagging elements are the financial markets, the industrial markets, industries, the materials market. Oil, I believe, is breaking down, and it's starting to show up in this chart. Unless something dramatic happens, I'm still going to say that. An XME, which we just looked at, I'm going to do a forecast on this chart in the next few weeks. That's not what it's going to look like. This is what I think it's going to look like. It's going to do that. As the Chinese market bases and has a large rally, this will do a strong rotation back into the strengthening quadrant. So normally speaking, if all the technical information you had was a sector rotation chart, you'd be out of all your metals and minings. But when you start to look at the pattern behavior, volume, supporting the pattern, what's driving the market, you've got a complete picture, and you know to hold your metals and mining shares, especially if you're in Australian shares, because they've just been tracking sideways and they're probably about to have a rally to the upside. Okay. Let me just jump across to, I'm just reading my pad as I'm talking. Let me just jump across to the other elements of the market, which I believe are very, very important. That's gold and currencies. They're all linked. It's all these inter-market relationships, which are important to investing. When I come across to, let me start with, I think, FXA. FXA, as we all know, it's the exchange traded fund relating to the Australian dollar. and it's always best to look at it from a weekly perspective before we go down to the detail. On the weekly perspective, we have been following this and tracking this for quite a long time, and we are aware of the breakdown, and it went down to the 100% Fibonacci ratio 2 weeks ago. Now, in the past 2 weeks, it has been rallying, and my belief is that that rally will probably fail. And it just simply still looks like a counter trend to me, till proven otherwise. So if I come back down to a daily chart on FXA, for me to tell you this is not a counter trend, I need to see a base form, and I need to see a significant rally supported by volume. You know, that may happen, and maybe it is going to happen. Maybe that's what's going to happen. Metals and mining are basing, China's basing. This is all linked together. Maybe that does happen. But right as I'm standing here today, I can't pretend I can see into the future. I can't. I can only read the elements as they come into view. And at this point in time, if I look at the Australian dollar, it looks like a counter trend for the next fall. I see it's bounced off the 100%, and volume has gone positive, but that's what happens on a counter trend. I'll leave it at that. It still needs to prove itself before we can call the Australian dollar a low. At this point, it's still a counter trend getting ready for its next fall. If we look at its mirror image, it should be the US dollar versus the Australian dollar traded on the Australian Securities Exchange. And I think I'll jump to a weekly chart on that also, just to get the big perspective. This particular chart, as we know, had been trending down for many days, weeks, months, and years, and broke out of its significant downward slide. It has, in the past 2 to 3 weeks, come back to its upward moving trend line. For this to be supported on an ongoing basis to the upside, that trend line doesn't want to be broken. It has found support at that trend line. Looks like it's touched it twice. And in addition to that, it has switched from negative to positive volume in the past week. So that would be the case for the market in Australia, that is the Australian dollar, to once again fall if this looks like it's rallying. Does this look like it's rallying? Absolutely, it looks like it's rallying. It looks like it's forming a base on the trend line with increasing positive institutional buying volume. So the only thing that can make me change my mind is it does one of two things. It breaks trend tonight, breaks that trend line, starts falling over, or it does rally but fails to take out the previous high and then falls. We all know what that represents. It's an M top. So that's, it is still bullish at this point. So it has to do that, it has to do that. Or it has to do something that represents a technical top. There is no technical top. And at this point in time, repeating myself, volume, positive institutional buying volume, is supporting, in the short term at least, an upward move in this particular contract. I do look at two contracts. I look at the US dollar index, which we all know is a basket of currencies dominated by the euro against US. And I look at UUP. I think actually that's the same. It's an exchange traded fund representing the same thing. The numbers that I'm looking at, they look exactly the same. So let's come across to the gold market. If the Australian dollar has been falling and looks like it's continuing to fall, if the US dollar looks like it's had a pullback and looks like it's going to continue to go up as we stand here tonight, it means that the gold market should still be probably weakish. And as we pull up the gold chart, again, I have to go to a weekly to get a good perspective. We are absolutely well aware. We track it every week. It's been grinding to the upside, and we're aware that it broke down out of its channel, and it has broken based on a previous range, and has, as of this week only, reached its 100% Fibonacci extension to the downside. Opening up on a daily chart, as it hits each Fibonacci ratio, I need to look at the volume. Let's get my eyes off screen. When I look at the volume picture on this particular chart, there's zero evidence that that's a low. All as I can say is, from a volume perspective, the rate of selling has slowed. So what I would need to see, if this was a base about to be built at the 100% extension, I'd need to see a rally. I'd need to see some sort of retest. I need to see some sort of break of trend, and I'd need to see all that sequence of events that we know to be the evolution of accumulation, supported by positive institutional buying behavior. Whether the pattern be an inverted head and shoulders pattern or a W pattern is irrelevant, has to be some form of pattern that would support a low. So that hasn't happened. I'm making all that up. I'm just saying that's what I would be looking for a low to kick in, and for me to be convinced that that contract will stop falling. Just give me one moment. I'm just reading across my pad to make sure I'm not missing things. I just want to point out for people that are trading these rallies that I'm jumping back to US markets here. The three strongest sectors that you should be focused on are consumer discretionary, tech, and healthcare. Healthcare hasn't actually kicked in yet, but it's about to. I'm just going to go and just have a look at some of my shares within these areas, especially tech. Tech is just a fantastic sector and continues, even when markets pull back, just continues to rally. So these are the tech stocks. I am overweight in tech, and I believe I've said that. I've got more exposure in tech than any other sector. When I look at tech, while the market is struggling to, and when I say the market, while the S&P is struggling to break into a new high, the strongest sectors in the market are punching through into new highs. And what tells me it's so strong is when I look at individual shares like ADBE, broken into a new high. FTNT, broken into a new high in the last week. NOW, broken into a new high in the past week. SPLK, that had a counter trend, so it can't break into a new high until it recovers. TTD, broken into a new high just in the past week. TWLO, broken into a new high. So, the market might be languishing, that is, the overall market might be languishing, but as you well know, the market is not a single entity. It's 10 separate entities broken down into multiple different sub-entities, which move at different rates of changes of price. And your job as a trader is to not pretend that you can just pick any stock. You have to be involved in those stocks that are driving the market. They're the ones that have the fastest rate of change in price. And if you're a buyer of options, what do you need? You need fast rates of changes of price to earn yourself money. So that looks good. I just want to come across to very quickly, just out of interest, because I haven't done this today, the consumer discretionary stocks that I've got, which is IAC, hasn't gone anywhere. Netflix had a huge fall the other night, but it had a quick recovery. GRUB, looking good, hasn't broken into a new high, and ETSY. So that's my exposure on that market. That looks brilliant. That's going to break up very strongly. So they're your focus. And even if you're building portfolios, one of the tenets of portfolio optimization is somewhat weighting slightly to strength. So you're slightly overweight towards what you believe to be the strongest without focusing too tightly, because then you eliminate the benefits of diversification, and you're opening or increasing the risk of your portfolio to non-performance. Okay, one moment please, I'm just reading off my pad. Okay, I believe I've covered nearly all the points. I just want to go backwards and just cover one point. I just need to see who's in the room, but there are many people that listen to this via recordings, and I just need to make a point because people are on holidays. One is holidaying in the Greek islands. I won't say who, but he'll be listening to this via tape. And I'm really directing my comments to people who are doing SPY diagonals, because we've had a really, really good rally. And that rally has gone on for 13 to 14 days. And if you were here at the beginning of the presentation, it looks like it's about to go to the next Fibonacci. That said, the longer this extension continues, the increase for failure of a trade. Why? Because markets don't go up forever. So each trade that you take along the path of an extension, the least risk trade is the first trade you take. And I know I'm speaking the obvious, but some people get so focused in on the trade they're in, they're not looking at the big picture. So just be aware that if you are long the market, absolutely fantastic. But as we move forward another week, there is an increasing risk of failure. Hence, your position sizing maybe and your risk management should reflect the increasing risk of potential failure. It could be the positioning of your strike prices in relation to the market. That would be another factor, many factors that you could consider. Guys, I think I have been talking way too fast this evening because I have run out of content. The only other element I've got on my screen was just a quick review of some shares I put up last week. If you've got any shares for me, now's the time to punch them in. I just picked the 3 strongest consumer discretionary shares last week, or maybe it was a couple of weeks ago, and they were COST. I just like to keep on tracking just a handful of really strong shares. I don't necessarily own any of these, or maybe I do own a couple of them. I can't remember. I forget about it. So EL was one, which is going down, not up. SYY is looking good, and COST is looking really, really, really good. Okay, just give me one moment. I have got a few comments just being typed in. Okay, Alan's just asking for the recording to be put up soon. Alan, it takes me about 1 hour to render the recording, and then it takes another hour to upload. So I will immediately I'll start the process, but I apologize, it probably will be a bit in bed before it's up. So it's not something that it's not an instant click of a button. Okay, apologies. So Barry is just asking about Netflix. I did mention Netflix. Just let me have a look at it once again. I have got a lot of Netflix shares, I believe. And Barry, you probably know better the fundamental that drove this. I just typed in the wrong code. The fundamental, maybe you could tell me why this market gapped, irrespective of its gap, and I'm heavily engaged in Netflix since the April low. Okay, Barry said the reason was missed earnings report. Absolutely, that's fine. I'm not too concerned. I'm not getting out of Netflix. Missed earnings report, fine. It is. I think the rate of client acquisition across the planet is extraordinary. I won't be getting out of Netflix, but interestingly, before that market did do that gap, there was a lower high on screen. Not that that's predictive, I suppose, of anything. Interesting. Okay, Alan's saying it didn't meet earnings and the new level of contracts. I thought actually it didn't meet earnings and the contracts were growing. That is the amount of customers, but I may be wrong. Okay, it all looks good. For those craft beer drinkers in Perth, if you're ever interested, please contact me. I know I'm promoting a second business, but I'm often doing events during the week. I did one last week in Perth, and I got to brag that we won the gold medal in the Pilsner category, and we won a trophy for the best new exhibitor with the agricultural show, show people on the West Coast. So maybe if I can get to the East Coast, we do enter competitions on the East Coast, but the competition's so tough. We don't go, and we didn't even turn up to pick up our prize this time because we didn't think we were going to win. But I'll let you know if I'm over on the East Coast picking up medals, so you can come and see us. And Barry's asking, do we export to Adelaide? we do export to Adelaide, and I have to let you know exactly the people that we export to in Perth at celebrations. But let me stop promoting another business within a finance business. I'm just telling you that because it's fun. That's my enjoyment on weekends, is flogging beer, and I look forward to seeing everyone next week. Thanks, guys. Stay safe. See you then. Bye.